What if I told you that there's a secret pattern, a series of clues that have historically signaled the approach of a market crash? And what if I said that gold, the ancient relic of wealth, has been whispering these warnings all along? Today we're going to explore the steps of the S&P 500 and its silent dance partner, gold. We'll uncover the hidden messages in their movements and reveal how these signals have foreshadowed some of the biggest economic downturns in history. Since the year 2000, there have been three major market downturns, and in the run-up to each, gold quietly outperformed stocks by an average of 25%. Before the 2008 crash, gold's value increased by 30%, while the market index showed volatility. Now, with similar patterns emerging, are we on the cusp of another shift? The numbers are speaking. Are we listening? Let's find out. Starting with the stock market, the S&P 500 is a financial indicator representing the collective heartbeat of America's top 500 companies. It's a barometer of the U.S. economy and a benchmark for global markets. When the S&P 500 moves, it's not just a ripple, it's a wave that either lifts all boats or sends them scrambling for cover. It is closely linked to the broader economy. It reflects the performance of the large-cap market segment, which includes industries that are the gears of economic activity. From tech giants to financial firms, these companies' fortunes tell us much about consumer confidence, spending power, and the economic outlook. Looking back, the S&P 500 has been a witness to history's most significant economic events. From the Great Depression to the dot-com bubble and the 2008 financial crisis, the S&P 500 has weathered storms and basked in sunny days. It's a historical ledger recording the highs and lows of America's economic journey. With about 71% of revenues coming from within the U.S., the S&P 500 might seem like a domestic player. But look closer and you'll see it's a global footprint. The remaining 29% of revenues come from overseas, making the S&P 500 a global force to reckon with. It's a window into how international events, from trade wars to pandemics, impact U.S. companies. Can the S&P 500 predict the future? Not quite, but it can offer hints. Analysts pore over its movements, looking for patterns that might indicate where the economy is headed. A sustained uptrend could signal economic expansion, while a downturn might precede a recession. So what does all this mean for you, the investor? Well, the S&P 500 is more than just a number on a screen. We're going to compare the behavior of the S&P 500 with another metric as a way to predict where the economy is going. Even if you're totally new to finance, we'll simplify all the metrics in an entertaining and fun way. Later in this video, we'll look at the Dow to gold ratio, a comparison between how gold is performing in the market and what the stock market is saying. Don't forget to subscribe and add your feedback and questions in the comments below. Next, let's take a closer look at the historical significance of gold and the monumental impact of the gold standard's removal. So let's dig into the data and uncover the glittering details of gold's storied past. Gold has been a symbol of wealth and stability for over 5,000 years. Ancient civilizations revered it. Modern economies have been built upon it, and empires have risen and fallen with its flow. The historical price trends of gold offer a window into global economic health, reflecting periods of prosperity, crisis, and recovery. The gold standard was a global commitment to fiscal responsibility. Countries adhering to this system maintained a disciplined approach to fiscal and monetary policies, ensuring that the amount of currency in circulation was backed by physical gold reserves. This system provided a stable exchange rate environment, facilitating international trade and investment. The early 20th century saw significant economic upheaval, profoundly impacting gold prices. The aftermath of World War I and the onset of the Great Depression led to a surge in gold's value as a safe haven asset. The U.S. Gold Reserve Act of 1934 increased the price of gold, reflecting the government's effort to combat deflation. When countries began to abandon the gold standard, starting with Britain in 1931, it sent shockwaves through the global economy. The immediate effect was a major devaluation of currencies, which, while destabilizing in the short term, actually benefited economies like Britain's by boosting competitiveness and aiding recovery from the Great Depression. Post-World War II, the Bretton Woods Conference established a new monetary order. Currencies were pegged to the U.S. dollar, which was convertible to gold at a fixed rate. This system aimed to combine the stability of the gold standard with greater flexibility for domestic economies. The Bretton Woods system thrived for a while, but cracks began to show as the U.S. dollar struggled to maintain its gold convertibility. By the early 1970s, the system collapsed, leading to freely floating currencies and a new era of fiat money. With currencies no longer tied to gold, governments gained the ability to print money without the constraint of gold reserves. This newfound freedom allowed for more responsive economic policies, but also introduced the risk of inflation and currency devaluation. Once the gold standard was abolished, gold began to be traded like other commodities, with its price fluctuating based on market conditions. This shift allowed gold to be valued independently of any currency's value, making it a unique asset class. These fluctuations based on market conditions are what allow us to track gold as a way to predict where the market is going. Hey, if you're finding value in our exploration of gold's glittering past and its impact on today's economy, why not take a moment to hit that like button? Ready for more? Well, stay tuned as we look at intriguing patterns of the Dow to gold ratio and uncover the secrets of the stock market PE ratio. We're about to connect the dots between historical data and your financial future. Now, gold has been outshining the S&P 500, but is this glittering performance a prelude to a market crash similar to what we witnessed before 2008? Since 2021, gold has been on a remarkable run, outperforming the S&P 500. As of April 12, 2024, gold has climbed an impressive 81.65% over the past 5 years, eclipsing even the robust 76.22% growth of the S&P 500. This surge in gold's value comes amidst persistent inflation and global unrest, driving investors towards the safety of this precious metal. Before the 2008 financial crisis, gold exhibited a similar pattern. It rallied significantly, with its price rising from around $730 per ounce at the beginning of 2008 to over $1,100 by the end of 2009. This increase reflected gold's role as a safe haven during economic turmoil. Let's compare the numbers. The S&P 500 fell 28% versus gold from late 2021 through 2022, and despite a rebound in 2023, it remained 5% lower versus gold as of late February 2024. This divergence is reminiscent of the pre-2008 era, when gold's price was already climbing higher well prior to the crisis. Now, the Dow to gold ratio, which tells us how many ounces of gold it would take to buy the Dow, historically, a low ratio has indicated economic downturns. As for our current date, this ratio has been decreasing, suggesting increased economic caution. The Dow to gold ratio measures the relative value of the stock market, represented by the Dow Jones Industrial Average, to gold. It tells us how many ounces of gold it would take to buy the Dow. Historically, a high ratio suggests a bullish stock market, while a low ratio points to economic uncertainty and potential downturns. The Dow to gold ratio has been on a downward trend since 2021, indicating that gold is outperforming the Dow. This trend is similar to what we observed before the 2008 recession, where the ratio declined as gold began to rise in value compared to the stock market. A declining ratio has often preceded recessions as investors move away from stocks and into the perceived safety of gold, reflecting a shift towards caution and risk aversion. So what's the next step? Well, for the savvy investor, it's time to look at your portfolio with a critical eye. Consider how you can use the Dow to gold ratio to navigate the uncertain waters of the stock market. But how about an individual stock's value? The price-to-earnings, PE ratio, is a classic measure of a stock's value, indicating how many years of profits at the current earnings rate it takes to recoup an investment in the stock. A high PE ratio could mean that a company's stock is overvalued, or it could reflect investors' high expectations for future growth. As of March 31st, 2024, the S&P 500's 10-year P/E ratio stands at 34.2. This is a staggering 68.7% above the modern era market average of 20.3, placing the current P/E 1.7 standard deviations above the modern era average. Such a high P/E ratio suggests that the market is overvalued, indicating that investors are willing to pay a premium for stocks, possibly due to optimistic growth expectations or a lack of alternative investments. To put this into perspective, historical data shows that the average P/E ratio for the S&P 500 was 13.34 between 1900 and 1980. However, over the next 40 years, from 1981 to 2022, the average P/E ratio increased to 21.92. The highest ever P/E ratio for the S&P 500 occurred in May 2009 at 123.73 following the market crash. The P/E ratio is influenced by market sentiment, the overall attitude or feeling that investors have towards the stock market. When positive sentiment prevails, investors are more likely to buy shares, pushing up prices and the P/E ratio. Conversely, negative sentiment can lead to lower P/E ratios as investors become more risk-averse. Divergence occurs when two indicators that typically move in sync begin to move apart. In our case, we're looking at the S&P P/E ratio, which reflects how much investors are willing to pay for $1 of earnings, and the Dow to gold ratio, which compares the stock market's value to that of gold. The S&P P/E ratio is currently at elevated levels, suggesting that the market is expensive. A high P/E ratio can indicate that investors are optimistic about future earnings growth or that alternative investments are not attractive. Conversely, the Dow to gold ratio has been decreasing, implying that gold is becoming more valuable relative to the stock market. When the S&P P/E ratio is high while the Dow to gold ratio is low, it suggests a divergence in market sentiment. Stocks are seen as expensive while gold is viewed as a safer investment. This divergence can be a precursor to a market correction or downturn. Learning from the past, such divergences have provided selling opportunities for stock investors. For example, before the 2008 financial crisis, the S&P P/E ratio was high while the Dow to gold ratio began to fall, indicating that it was time to sell stocks and move into safer assets like gold. Hey, the numbers don't lie. By understanding and acting on these financial indicators, you can make informed decisions that align with your financial goals. Whether it's adjusting your asset allocation or taking profits off the table, these metrics are invaluable tools in your financial toolkit. Now that you're equipped with the knowledge to interpret these critical market indicators, it's time to take control of your financial destiny. Review your portfolio, set clear goals, and adjust your strategy to navigate the market's ebb and flow confidently. Hey, thanks for joining us on this financial journey. If you found value in our insights, please subscribe to Fun Financial Insights and drop one lesson you learned in the comments below.